These are the four checklists to determine the health of the US stock market. Currently, the US Treasury bonds are bad, inflation, interest rate, or yields, and the US stock market itself are at risk. And this is a downgrade from my assessment at the beginning of the year, the tutorial on 9th of January. The title is Three Indicators to Watch for 2026. The US Treasury bonds were already bad, inflation and the yield were at risk, but the US stock market was only at a cautious level. I will uncover them one by one. My name is Con Hao. I enjoy studying how different markets currently behave to uncover emerging trends, the potential trending markets of tomorrow. This analysis is based on technical studies and does not constitute financial advice. Please consult your licensed broker before investing. For a healthy economy and its stock market, the government bond should remain on the uptrend. Inflation should maintain at the band between about 1 to 2%, and corporate yields and interest rates should be at their lowest level or lower level. But what we're seeing here today is that the US Treasury bonds broke below their multi-decades uptrend in April 2022. And based on the current Middle East tension, the US inflation is at risk of trending higher in the coming months. And how about the yield? So this put the US interest rate or yields, which are already at elevated level compared to its previous years, at risk of further hikes. Corporate bonds yields are already indicating this. When I say yield, I'm referring to corporate bonds. And also, let's take a look at the US stock market. As we approach the close of this quarter, what we're seeing here is a 3-month chart. This was last quarter, and this is this quarter, just a few days about the close for the quarter. And the Nasdaq also indicated a potential double top, accompanied by a bearish engulfing body. And what I believe is this: the trigger will be the yield curve when it starts to invert again. Let me explain what is inverse yield curve. It is where the lesser loan tenure interest rates, for example, the 2 years yield, which is represented here in yellow, is higher than that of the longer loan tenure interest rate, like the 10 years yield, which down here represented in orange. And when the shorter term borrowing cost is higher than that of the longer ones, this spells troubles. It speaks of liquidity concern by major investors. And we saw this inversion happen after July 2022, and it lasted for 1.5 years. And during the same time, the Nasdaq also went into a bear market for the whole entire year when the inverse yield happened. And the key is this: we don't have to wait for the yield inversion to come and to take action. And it seems that the shorter term, which is the yellow, now is racing faster than the longer term. It may invert pretty soon. So we should take a more progressive steps. When things don't seem to gel together, especially when the checklist is all pointing towards either bad or at risk, also the current development seems to be aligned with our studies. So because of what we've just did, all these studies, I've been observing closely on the monthly close in the past month of the US stock market. So this was a tutorial that I did on the 4th of March. So every month I've been observing on how the market closed. And in February, it was a very short month. Last day was on the 28th of Feb. And we know what happened to 28th Feb. It was the beginning of the Middle East crisis again. So 27th Feb, which was on the Friday, was the last trading day for the month for Dow Jones. And what I saw was an inverted hammer. And it's pretty rare to see such a classic inverted hammer since 2008. It only happened twice. This was the second time after 2008. It was so classic. And then on Saturday, it happened. So what we saw here was that. And I posted another one, which is 1 week later, as a published case study here. And what is the outcome? As the month then March about to close, we saw a deeper correction. And so this is my weekly reference where I suspect that on any retracement to me is seems like a sell to me. And this is a guideline that I have projected for myself. And another example, taking a more proactive role in how we invest and trade when things don't make sense. On 10th of November last year, so this is what I posted, and the title is AI Valuation Technically. So this is what I've saw. I saw for the first time that the Nasdaq on this daily chart start to break below since April, and then what is the outcome today is still stay under Microsoft. They form a double top. And what is the outcome today? It is much lower. And Apple, there was a divergence, and today it still stay under. And for Nvidia, we saw a bearish engulfing body on the weekly chart. And whereas Nvidia today, it seems to be supported at about 170. But if it break below, I think there'll be a little meltdown for Nvidia as well. Another divergence observation. In case you are wondering why precious metals is under pressure when inflation seems to be on the rise, the answer is gold is not an interest bearing asset. US yield, as discussed, are more attractive now, and there is a flight to quality for the time being. You can visit my recent video titled Why Precious Metal Are Underperforming. It's going to range for the time being, but I believe the uptrend for the precious metal will pick up again. Feel free to leave any comments below. I love to exchange ideas with you on what is about to come. Really happy that I stayed through this tutorial. You have many great trading weeks ahead.